Good afternoon, Easy Equities community, and thank you very much for joining us at Chat with Charles, our CEO, and Giulietta, co-founder of Currency, a new financial services publication. It is take two for this webinar, and we're delighted that hundreds of you are joining us. My name is Carl, for those of you I haven't met, and you've just listened to a song written by our very own Veronique for our 10th birthday, and also performed at the JSE last week when we listed our second and third actively managed ETFs, and you'll be hearing a lot more of that as we get it to number one with the EasyEquities community. Giulietta is going to be chatting to Charles a little bit. You may already have seen an interview that she has done, a Q&A relating to some of the results. That's on Currency News, which you can check out. You get a few free reads of articles from Currency, and then you can subscribe, and there's some great deals on at the moment. Charles is also on MoneyWeb, BizNews, and a number of other publications and media outlets. But we're delighted that you, the EasyEquities community, are joining us here today. So without any further ado, I'm handing you over to the very smart, the very good-looking, the very funny, the very entertaining, and let's hope she has brilliant questions and leaves no stone unturned, Giulietta Talevi.
Thanks, Carl. Let me not mess this up because that would be a bit of a tragedy. And welcome to everyone. Charles, the results which have finally come out show a hell of a turnaround. You've got HEPS of 1.77 cents a share from a loss last year of just over 2 cents a share. Revenues were up 45% for the Purple Group to 400 million rand. How did it all happen? Because it sure as hell wasn't the economy that threw you a bone.
Yeah, firstly, let's apologize for not getting the results out yesterday. We're one of the few companies that publish our annual report and the results at the same time. That just means we place quite a lot of pressure on ourselves to get it right. But apologies, everyone. I hope, like me, it was worth the wait. So, Giulietta, just to the question. I mean, firstly, they're big numbers. 400 million is a significant change in our income statement. And if you consider that EasyEquities is 80% of that number, 90% of that number, 360 million, the balance from mostly from GT247, we've produced a very good result in very tough economic times. So, to your question, what drove the result? It was the diversity of the offerings and capabilities, products and platforms that really drove it. And if we want to single out some of the star performers, EasyEquities, the traditional core business, did very well. It did well for two or three reasons. The first is clients pitched up and deposited more than they have in previous years. In fact, they set records month on month from February all the way through, I can say to today, November. They've set monthly records for that month looking backwards. And deposits are the sharp edge of the sword for us. The more people deposit, the more they've got to do on the platform, the more assets they have, the more revenue we make. So clients pitched up. Why did they potentially pitch up in times at the end of a very tough economic cycle? And what are we talking about? We're talking about interest rates. So as interest rates went up, our clients' propensity to invest went down. That was until we introduced Thrive. And Thrive was designed to bring front and center, do a couple of things. One is for our customers to think about us more often. Two is to pitch up more often in order to avoid fees. And pitching up meant you could do a whole lot of things that were good for you as an investor. One is you were rewarded for having net deposits, so depositing more than you withdraw, just 1 rand more than you withdraw. Two is you could pitch up and educate yourself, which education proves and compounds over time into your own investing activities. And then three, you could use more products and services on the platform at a lower cost structure. And fundamentally, if you didn't pitch up, it charged you a fee. Both of those created an economic outcome. The one is easy to translate. When we charged a fee, we charged our customers 25 rand for not pitching up, if you like. And in a lot of instances, in fact, in most instances, people saw that as a fair value exchange. If you look at what we do, we pitch up 365 days a year. We look after your assets in South Africa, the US, UK, in Europe and Australia. We don't just look after your listed assets. We look after your crypto assets and your property assets. We look after your unit trusts and everything else. And for all of that, we charge you 25 rand a month. And if we contrast that, on average, our customers pitch up 10 times a day to check in on their portfolios. If we contrast that for other things that you pay for in your life, like potentially a bank account, where you pitch up 5 days a month, typically mostly around payday, and you use services that are 100% localized South African environment, you pay multiples of that, 120, 150 rand. So our customers paid the fee happily in order for us to provide the platform and look after their assets. And that had a significant economic impact, which you can see in the numbers. It drove revenue very strongly. Outside of Thrive and outside of EasyEquities, the revenue was driven strongly from Easy Crypto. So crypto assets doubled in the period, and that meant that revenue also kind of doubled. It did better than that, in fact. Revenue was up even stronger in Easy Crypto. We've seen two kind of very strong bull markets in crypto. The first was in March, where inflows were just unbelievable, and that obviously had played out in the economics results that we're reviewing today. But we're seeing that occur again now. Crypto's having another bull market this year, and so that's not in this set of results. So crypto had a great set of results, and then Rise, or Easy Retire, our institutional asset management and administration business, also had a very good year, delivering, building on the results that they put out last year. They pitched up and added to the results of last year and produced a very significant and strong set of results. So across all of the core business units, we produced very strong results. And fundamentally, back to your question, why did customers pitch up in tough economic times? Look, I can only give credit to our marketing and journeying approaches. So, we've worked much harder at being front and center with our customers and convincing them that other parts of their income statement should be sacrificed and not investing. Two is our user experience team, our platform team, worked very hard at integrating our products and platforms so that they present themselves better to our customers, and and had strategies to remove friction around things like deposits and consuming other products on the platform. And three, our team just worked much harder and were much more focused on driving better deposit behavior across the board, which culminated in us delivering Thrive.
Charles, but actually, taken overall, if you look at the increase in active clients, it wasn't massive. It was about 10%, and that's lower than normal. Are you worried about that? Do you think is that area that you could do work in? In our interview, you talked about you actually didn't use much marketing spend because you figured it was kind of almost pointless to try and convince people to sign up in a very tough economic environment. So I wonder what you're going to do there. Or is it simply that you've got to convert the over 2 million people who are registered users to becoming active users? And how are you going to do that?
Yeah, I think that 10% number is probably one of the more disappointing numbers in the results set. And when I say disappointing, it was planned to be disappointing. It wasn't strategically disappointing. And that is, you've highlighted what I said. It would have been ridiculous to spend money in an environment where consumers are struggling to keep the lights on. And just don't have the capacity to invest. And we did spend money early on in the year. We tested different approaches and strategies, and it just didn't deliver the marketing results. And so we spent all of our marketing money internally and focused on the customers that are in front of us. And having spent very little money, we delivered a really good result. I mean, 10% on a 2 million rand on a 2 million base or a million base are still good numbers. But I think there's lots of room for improvement as the economy eases, specifically as interest rates go down. So, what people can expect from us in the future is, as you see interest rates coming down, you should see EasyEquities around you more often, and we'll increase our marketing spend. And I think that's a number that we could do better with in the future, i.e. get higher onboarding numbers. So
Charles,
yeah, it's
up there, and because the question that's come through, which might be pertinent to that, and I don't know if you can see that question, and the viewer says, EasyEquities received many bad reviews on Google, mostly about bad service and issues with the app. How are you working on solving this? I'm a happy client. However, I'm concerned that bad reviews that are unresolved will hinder the growth of EasyEquities. I mean, I'm a client. I'm happy. I have noticed that actually, and I kind of wonder what that's about, and whether it's something that you would try and tackle.
Yeah, I mean, we've got a channel for bad reviews inside the business. So every single bad review gets sight of the entire team. So and I'm probably the person who reads it first and last. So I read it a few times, and so that we take them very seriously, and we kind of dissect them and weigh them. So firstly, if there are lots of bad reviews happening in a specific area of the platform or business, then we optimize that area, put weight on it, and optimize that area. In some and those buckets, there's no question that we make user experience. We make poor decisions sometimes around user experience, and we rectify it very quickly, and we learn from our customers. But there are lots of user experience areas that are outside of our control. So, for example, there are users who haven't bothered to educate themselves about how to use the platform, despite the fact that there are tens, if not hundreds, of videos around how to use the platform functionality. And so then they'll complain about something that actually it's a feature within the platform. It's something that we can't, not engineer, or it's something that's been put in place to safeguard them. So, as an example, debit orders are locked up. And correct me if I'm wrong, but it's not really, they're locked up for a period. And so if you make a debit order deposit, you can't withdraw the money for a period. Now, people will complain about that. And you go, yeah, but debit order fraud is so prevalent in South Africa. If you don't do that, then the cost of that fraud eventually is going to come back and hit someone, either Purple shareholders or our customer experience, because we abandon debit orders because nobody else, because the fraud is so bad. So we take them very seriously. We pay little attention to the good reviews. But it's interesting, just for reference sakes, the customer base is kind of bipolar. It's either a 5-star review or a 1-star review. There's no kind of middle ground on it. And, for every bad review, we're getting a 1-star review. We're getting a 5-star review. So what is important for us is to make sure that we aggregate those 1-star reviews and fix them as fast as we can. And a lot of those bad reviews come from the fact that the platform is changing faster than it has for some time. So we implemented platform 3.0 in August. Since then, it's gone through 6 revisions based on customer feedback. And for a large portion of our customer base that's become very comfortable with a platform that hasn't changed the user experience at that pace for some time, that change is uncomfortable. And so that manifests in bad reviews. So we obviously take it very seriously. It is, when we look at it as a percentage of customers, it's a very small percentage, but despite that, it gets a lot of airtime in the business, and we've got a whole team focused on resolving those friction points.
I mean, and back to my question about converting the registered users, do you think that's going to happen at a more rapid pace, or at a pace that is kind of hindered by what happens in the economy?
95% of all users are converted within the first 12 days. So the window of opportunity is literally from the point that they register, for another 2 weeks roughly. And then 5% of the customer base kind of convert over the rest of time. And we've become more successful at unlocking that 5% with different strategies, different products, and different services. So as we expand our product offering, our services to new markets, we get better conversion rates. Also, the tools with which we market to this customer base are improving. Now, as an example, using AI as a conversion tactic is improving the result. So we always look back and say, well, can we get a better conversion rate out of that customer base, and try and see if we can. But if you look at it all time, roughly 2 million registrations, roughly 1 million customers, that's a 50% conversion rate. That's unicorn kind of status. That's not normal in financial services. Financial services typically have about a 12 to 15% conversion rate in a perfect world, like in their best years. So 50% conversion rate is really good. I do constantly look at that million unconverted opportunities and think, wow, what do we need to do to unlock that? Because we could double the business overnight if we unlocked it. So we are constantly looking there. But it's just part of what we do, not a core focus.
Cost to serve went up slightly. It feels like 1.9% in your environments. But is that something that shareholders might be legitimately worried about? That the cost to serve per customer is going up rather than coming down? Sorry, Charles, can you hear me?
I think I got the question, Giulietta. You can step in if if I didn't get it, but you were talking about cost to serve and the fact that it went up for the first time in a very long time. And it went up. Let's just contextualize. It went up 1.9%. It's very low. I think it was 173 rand per customer. We think there's about 20 to 30% efficiency to be gained in still reducing that number. We really, and fundamentally, we actually think that the inflection point is AI. So leveraging AI to deliver more platform capability at a lower cost. But that's not going to happen in 1 year. That's kind of let's call it a 3 or 5 year strategy as AI tools start to advance and develop and solve problem points for the customer base. But cost to serve is, if we reference international markets, we're best in class. The guys who hold themselves out as being best in serving customers in the fintech space are Nubank. They do it with $1 per customer per month, which is $12 a year. And that's pretty close to where we are. So we're very proud of that number, but we do think there are efficiency gains. And the other thing is South Africa, we operate in an inflationary environment that is double digit, not single digit. So in a double digit over a 3-year period, if we look at inflation over the last 3 years, it's probably averaged 7 or 8%. And we've managed to bring cost to serve down 2 of those 3 years and marginally up 1.9% this year. So I think it's a very good result considering the environment.
And on the financials, a question came through about whether or not you'd reinstate a dividend, or is it too soon? You'd want to show maybe another year or two's worth of profits before you would consider such a thing.
Yeah, I mean, we're sitting with about 165 million cash on balance sheet, so that feels good. It's nice to have a bank statement that supports the group. I think we're entering a growth phase again, and not that we haven't been in growth. These numbers are high growth, but what I mean by a growth phase is a more supportive growth phase. And fundamentally, that means there's going to be more opportunities for us to invest and use our balance sheet and our cash. And so there's certainly no dividend policy in the foreseeable future. But where I would like to spend more of our cash is in funding growth over the next 2 to 3 years. As economic conditions continue to improve, i.e. interest rates come down, we need to be braver with that cash and get a better return out of it than what interest yields will give us. So no dividend policy. We've got lots of ideas and areas to invest in. We're just waiting for better economic times so that we can deliver that investment and get a better return out of it.
Charles, at this stage, does that mean more products or different geographies? And the reason I mentioned geographies, it's almost like a footnote now. You talk about you're making strategic progress in Kenya and the Philippines. And I wonder if the Philippines is the sort of problem child that no one really wants to talk about until they're out of rehab and you can show them off again at the family gathering. Whether that's what the Philippines is for you now. And then I'll go back.
Look, Giulietta, if you look at, I think let's just reflect on these set of results and say the following. They represent a decade of disruptive growth. And if you use them as a scorecard for what we've achieved over the last decade, it's a very good scorecard, and I'm very proud of what we've achieved. But what improvements do we need to make in the decade ahead? And how do we accelerate growth? What are the lessons we've taken from the last decade that we can translate into the next decade? And that speaks to what you're asking in 3 ways. We chose 10 years ago that in order to democratize access to investing, we needed to drive partnership. That was a very purposeful strategic choice we made, and we built very strong partnerships with banks like Discovery and Capitec. The choice that we made is that banks would give us access to customers at a faster rate than other channels might have. And actually looking back, we could be criticized for making the wrong choice there. Had we partnered advisors a decade ago, we might have accelerated growth faster. And so the next decade, our kind of pivot is we've built incredible and sustainable relationships with banks. We want to maintain those and build those relationships, but we now want to deliver our products and platforms in partnership with advisors. So that's one area that I think is going to provide us growth in the next decade. The other one, which is the one that you highlight. So, we've won the Currie Cup for 10 years in a row, and we failed to even get on the pitch at the World Cup. And that is a very fair criticism. We talked about it, but we didn't do anything about it. We didn't actually play any games in foreign countries. Now, we obviously are on the pitch in Australia, but we're on such a small pitch and that nobody kind of notices. So, I give us 0 for taking what is, and not arguably, what is ostensibly a world-class platform and only delivering it to South African customers. So the next decade, it is a core part of our strategy to ensure that we deliver it in other parts of the world. And so when whilst Philippines is a footnote and so is Kenya and so are ambitions in other territories like Australia, it's a footnote because I don't want to talk about it. I just want to do it and then deliver the result and win the World Cup while, without everyone knowing that we're playing in it. And I also don't want to just distract the group from the following kind of fact. 80% of what we need to achieve in the next 3 years, we've already built rails to or products for, i.e., it doesn't matter what we start in the Philippines today. It doesn't matter what we start in Kenya tomorrow. It doesn't matter what initiatives we invest in Australia tomorrow. It will not disrupt 80% of the result that we will get by just focusing on the South African business, South African products, the South African partnerships, the South African platform. Because as you can see by these results, we're not playing with small numbers anymore. To make a 10% impact on the group, you've got to produce 40 million rand in revenue. 10 years ago, that number would have been 3 million rand in revenue. A 10% impact on Purple Group 10 years ago would have been 3 million rand in revenue. So in order to make an impact on this income statement, you've got to come in hard and fast. That doesn't negate the fact that for the next decade, we have to create the next South Africa. And so we have to get better at executing our business plan in foreign jurisdictions. And, to talk openly about Philippines, we've constantly moved forward there, albeit at a very frustrating pace. My expectation, which is an expectation based on, conversations with the regulator, is that we will be allowed into a sandbox next year, so next calendar year, and we will be able to test live customers in that sandbox, but in a very restricted, controlled manner that isn't going to disrupt our income statement. And once that's done, we will launch in the Philippines, and I don't expect that to be next year. And so we're keeping it a footnote because we don't want to raise expectations around it just yet. Kenya, for me, is just another South Africa, but it's a South Africa that's starting 10 years ago. We've got to go out and find our first 10,000 customers in that country, and then the next 100, and then take it to 1 million over a decade. Australia is a little different. Australia, we've taken a strategic view that the competitive landscape is significantly, more competitive than it is here in South Africa. And by investing in our South African capability, eventually our platform will be able to disrupt that market, but not yet. And so once we've invested more and we've demonstrably evidence that our platform is better than what's available in Australia, then we'll start to market more aggressively in Australia. So, our scorecard for the next decade, or pivots or changes in our approach for the next decade, have to be: 1, retain focus on the core asset South Africa, take a 400 million rand income statement and turn it into a 4 billion rand income statement. 2, improve your execution in foreign markets. And 3, pivot your partnerships into advisory services or into advisory market to acquire their customers or enable their customers faster and more rapidly on the platform.
Okay. I mean, in theory, this should have had a huge jolt to your share price today. And I think people on the platform are both users and shareholders. I'm in a strange position of being a journalist, so I've got to be critical and unbiased, but I'm also a user and I'm also a shareholder. I was surprised that there wasn't any immediate impact in the share price, and I wonder if it's frustrating you or if you just have to ignore the share price for now, because over a year it's certainly recovered massively. It's up about 70% from the lows of 69 cents. But going back to 2022, when you hit R3.37, one still feels kind of poor as a shareholder.
Yeah.
Well, how do you look at?
Geez, I think I've been CEO for 14 years now, And the one thing it's taught me a lot, but the one thing that keeps standing out is I can never predict the share price. We have bad results, and I think she's going to get hammered and it stays alive. We produce extraordinary results and nothing happens. But fundamentally, what I do think produces a good share price is consistently good results. And I think it's a fair criticism to say that we've had flashes in the pan. We've had 2 or 3 sets of results stacked up that look really good. So 2 or 3 periods, 2 half years and a full year, or 2 full years in a row, where we've produced good results. But then we've undone a lot of that momentum by producing a disappointing set of results. And I think that's a fair criticism. The business is, as I said, 90% of the income statement is easy. Easy is only 10 years old. So it's learning about itself. It's learning about its economic model. It's not even a teenager. It hasn't even learned how to sprint yet. It's just walking faster than it did before. And so what we've learned about the business in the last decade is how to make it more resilient across all market conditions. And this income statement represents that. This is a hard-fought, good set of results, i.e. profitable set of results in the worst economic times we've ever faced. You can't say that this year was easier than the year before. It wasn't. It was harder because interest rates had been there longer. So we built a more resilient business that is sustainable across all economic conditions. But I think the market, and it's going back to the share price, the market will overreact when we deliver consistent good results and we stack them up period on period. And so where the focus has to be for me and the team is as we delivered a great set of results in February. We've delivered a much better set of results now at year end. Our focus is already on February to say, let's deliver an even better set of results in February and then shift focus to the year-end results. And I think if we do that consistently over the next, 3, 4, 5 years, what you'll find is there'll be an inflection point where the market goes, okay, they've matured. They're out of the startup phase. They're more mature. They've learned a lot and they've built a much more sustainable business. Personally, I think we've built that. I think the evidence has to be proven through consistent good results stacked on top of each other for 3, 4 periods in a row. So, does the current share price frustrate me? Of course it does. I'm a shareholder, and I don't think that R1.10 represents the value of the group. But then I must stop worrying about the share price representing the value of the group, because I'm not looking to sell any shares. What I'm doing is focusing on building a business. And I think the key must be just stack those results up on top of each other. And if we do, there'll be an inflection point and we will surprise the market.
Yeah.
Giulietta, can I jump in there? Sorry,
Yeah.
Giulietta, I just want to jump in there and pick up. I'm answering some questions in the Q&A, but also I will give you an opportunity to wrap up with a couple more questions. But Charles, if you can talk a little bit about platform and tech and issues around that. There's sort of a couple of questions. So maybe just address that, please, as we give Giulietta a break to think of the next hard question.
Yeah. I mean, as guys, we don't hide from the fact that, there are 2 types of things that we do. One is we drive innovation at a rapid pace. And what that means is that because we're moving at pace, we don't wait until 99% of the risks are mitigated in launching a product or service. And what that means is from time to time, we trip ourselves up. We make a mistake very publicly in front of you as customers, because we're trying to deliver at pace to your needs. And that's our fault. And I'm happy it's a kind of price of innovation, if you like. But the second part is we rely on a tech platform capability and infrastructure that is not entirely ours. So, as an example, we don't host our own platforms. They're hosted in the cloud, and and there are multiple service providers that underpin what I would call the infrastructure of our platform. And the most recent outage yesterday, can you believe it? I mean, what a day to have. We were supposed to have our results out and our platforms down. I mean, I can honestly say, and I want to be transparent about this, that was my second worst day in the history of my career. The worst day was 14th of February 2008 when we put GT away. But bottom line is that was my second worst day. And there, part of our infrastructure failed. It's not a piece of infrastructure we manage. We have a supplier for it. The response to that failure was slow because it was highly complex, and it's not in our skill set to resolve. We had to rely on a third party to resolve it. They ended up actually moving our infrastructure. So in the time that we're down, we actually transitioned. We moved the entire infrastructure to a new platform, and they haven't quite resolved exactly what happened. They're 90% there, but we're not gonna say what it is 100%. And to the extent, once they've come back with a full and detailed report, if it's something that we need to do to invest in a piece of architecture, software, or an additional supplier to ensure it doesn't reoccur, rest assured we'll make that investment. But it was something that was outside of our control. And so, we take accountability for all of it. It's our fault that we were down yesterday. I'm not blaming it on another supplier. Where it's in our hands, we are always doing our best to ensure that there's no harm done to our customers. Where it's out of our hands, we've got to reflect on our suppliers and partners and say, guys, is there a better way of doing this? Can we get other additional support services? And we'll do that. I think if people, if you take a step back, just zoom out for a second. Our platforms are up 99.9% of the time, which means, and we operate 24 hours a day, 7 days a week. We operate across multi-jurisdictions. So there's no rest for us. We're operating when some of our markets are asleep, other markets are awake, crypto's always alive. And so 99.8% is what we target and achieving. We have to recognize that as a technical platform, platforms go down. Netflix, I couldn't watch the Tyson fight. Netflix went down. And there are times it's how you manage when you go down and what you learn from that experience and then how you repair that really matters. So, be confident in the fact that we are 100% attentive. I wear this, on my sleeve and on my heart, and we'll do everything we can to ensure that doesn't reoccur.
I have to say, I've never seen you as grumpy as I did yesterday.
Yeah.
It was
You
not.
should have seen what other people saw.
Charles, can you talk a little bit about UX and improvements on the platform and different versions and how that goes about? So there are a couple of people that are critical of that, a couple of people that say it's not easy. So maybe how we arrive at where we arrive and also how people can influence it.
Yeah. So platform 3.0 has been, if you like, 10 years in the making, guys. So, how did we get to the point that we released such a radical departure from the previous platform? Well, you guided us there, users, your data, your needs, your wants. If you've been a user for a long time, you'll know that we survey you regularly. We take all of your customer feedback. So platform 3.0 is a culmination of your needs, desires, and wants. But here's kind of the nub of it. There are 1 million of you. And let's say that 60% or even 51% wins. So 51% of you architected this platform. That means that 49% of you didn't. And it means that there are going to be user cases because we're so diverse in our offering. I mean, I can't stress this enough. We've got 12-year-old kids at the very start of their journey and 99-year-old gogos at the very end of their journey, and everyone in between, economically, demographically, and we're trying to service all of them through a single front door. Now, Platform 3.0 has been designed to do that. And one of the things that I think we haven't done enough on and the user hasn't recognized is the platform is completely customizable to your needs and desires. So you can customize what you see and what you don't see across the platform and deliver the platform experience that you want. Now, very few users are doing that. They're using the platform as it's delivered to them rather than customizing. And I think it's just a familiarity thing. I think people were comfortable with the previous platform, but this is a significant departure. It allows you to tailor the platform and services specifically to your needs, desires, and wants. Did we get everything right? No. But what our commitment is, and as I've said earlier, we've had 6 releases since we launched the new platform in August. You can expect that to continue for at least the next 12 months. So we're going to keep learning through your data and improving the platform. But I'll implore you, if you like the platform, fantastic. I'm telling you, you can like it more if you customize it. But if you don't like the platform, then my question back to you is, have you tried to customize it? If you haven't, please do. And then if that doesn't meet your needs, please tell me why you don't like it and be explicit. And send us images and so that we can improve it. Because all of the improvements we've made since we launched it have all been thanks to your input. And I think it's a wonderful platform. But we've still got learnings and lessons to take from all of you. And I think the only thing I'd ask is understand that the diversity of who we're servicing means that the platform can never meet everyone's expectations all of the time. Hence why we've allowed you to customize it for yourself.
Thanks, Charles. Before I hand back to Giulietta, just to also suggest to everybody on this call, please read our financials. Purplegroup.co.za, you go to financials. There's a long section, very detailed feedback from our product champions, from Charles, talking about our current business, talking about future plans, giving a lot of information. So numerous people in the team have really spent significant amounts of time explaining what they're doing. And we'd love your feedback on all of that. But a lot of the questions are answered in that. And whilst we are very critical of ourselves, and whilst we also want to be 100% perfect, we realize that we're not. So we welcome your feedback and your suggestions to us. Back to you, Giulietta.
I think I just have one last question. Thanks, Carl. Is it correct that your client retention was more than 100%? How does that actually work? And is that kind of a key marker for investors in the year ahead?
Yeah, great question, Juliette. I think it's one that's actually often overlooked. So, I mean, basically, nobody leaves. I mean, that's the kind of short answer to it. And so,
like the Hotel California of trading platforms.
Yeah, exactly. No one leaves. And you know, how does it get more? You know, how do you have more customers than last year? Is what we do is we look at the registrant year. So what year did you register in? And then how many customers have we got in from that registration cohort year on year? So we obviously it shows that we're converting more customers from older registrations, and you can see that pace is small, but it also highlights that nobody leaves the platform. I mean, I highlighted the data in another question. Prior to Thrive, for every customer we gained from a competitor, we lost a customer to a competitor. Post Thrive, for every customer we lose, we now gain 4. And it's interesting, and I don't want to name our competitors because I think they all do a really good job. But it's interesting, the customers that shouted the loudest about Thrive, we're acquiring their customers the fastest. And it's interesting, what is interesting about that is we've never, and Giulietta, you've been around us for a long time, we've never used fees as a way to beat up the market. We've always said we're the easiest. We've always said that we focus on access and fractional shares and making investing easy for everyone. What we didn't say is that the rest of the market is expensive and cumbersome and filled with friction. We never said that. I've said it now. But when Thrive was launched, suddenly everyone wanted to talk about fees. And so as a result of talking about fees, people have come to the realization, and the realization is the following. We offer more than our competitors do. We offer it with less friction than they do, i.e. lower minimums, lower costs, fractional shares. We offer more access to more products, unit trusts, ETFs, South African shares, US shares, European shares. We offer access to things that can protect your wealth, like life insurance. We offer you access to affordable credit so that you can reduce costs. And the list goes on. We do a whole lot of other things as well, including giving you access to zero brokerage. And if you don't pitch up and put 1 rand in the platform, you get charged 25 rand. And none of our platforms that we compete with have got the ability for you to avoid fees. They either charge them and mostly do. So for me, it's the fact that people don't leave is huge credit to the platform and the capability of the team in retaining customers. But I think the more exciting part for now is that we're starting to acquire customers faster from our competitors than we ever have. And it wasn't because we strategically decided to attack them. They attacked us, and they now have to live with the consequences.
Well, I think I should leave it there because Carl probably will shout at us because we've gone 10 minutes over time.
No, it's good. No, it's good. Thank you very much, Giulietta. I appreciate your time. So just to remind everybody to check out the article that Giulietta did on the results with Charles. That's in Currency News. Giulietta, maybe you can just tell people where they can access that, please.
Sure. It's www.currencynews.co.za. And there's 3 free reads a month. So until you sign up.
Cool. And there are a number of
award-winning
journalists. Charles, I'm going to ask you, sorry, just a couple of...
Sorry.
No, I'm going to ask you a couple of questions and then you're going to wrap up. So don't worry, there's some time. So just a couple of points I want to make to everybody listening. Again, firstly, thank you very much. There's been a huge amount of Thank yous and appreciation, both in the comments and in the Q&A. So a massive thank you to the community. There are a number of our team on this call as well. And I want to say to every single person that's a client, not to underestimate the value that we place on your custom and how you support us. Every single person at EasyEquities Purple Group gets up every single day to do better, to improve, to really make sure that you have the best investment experience. We're all clients as well, and so when things aren't working, we're equally frustrated and we're affected. But a massive thank you to you. Please check out academy.easyequities.co.za if you haven't. Please. There are significant amounts of education there. We've got a new head of education, Veronique, that's doing more and more. It's free. If you want to see more education, let us know. But there are some fantastic tools. Please check out support.easyequities.co.za. There is frustration at times that a ticket's not responded to immediately. Please go and read the FAQs. You'll be surprised at how much of that is answered when you do that. The reason that we don't have phone services is we're going to service 1 million clients by phones. We will increase costs. And as I've said 1 million times, EasyEquities clients are smart. So please use those resources. Please look at social media, our YouTube. There are a tremendous amount of resources that Carly and the team are putting out there. And finally, before I hand back to Charles, check out the annual report. It's a detailed document that we are really proud of. It tells you everything about our strategy. It tells you what we're doing now. It tells you what we're going to do. If you're on this call and you're interested at all in Purple Group, please read the annual report. Most of your questions will be answered there. Anything else, always happy to engage. And thank you very much for joining. Charles, last words to you, please.
Yeah, look, everything I wanted to say is in my annual report. So I echo what Carl said, but I think it warrants just saying one thing one more time. Is I can't tell you how extraordinarily grateful I am to all of you, to my staff, to our supporters, Giulietta, our partners, Discovery, Telkom, Satrix, and Capitec, and to all of you, our customers. Like I couldn't think of a better job in the world than mine. Having to stand on the shoulders of all of you and tell our story is an extraordinary privilege. And yesterday I really had to reflect on that privilege. I kicked myself. I've got myself out of bed this morning going, you know what? This journey has been filled with lots of small failures, but in the outcome, we are forging such extraordinary success. And it's not because of any one part or any one individual. It's because of all of you. And so please keep your comments coming, keep your criticisms alive, keep challenging us to be better, keep expecting more from us. And I promise you, we're just at the start of delivering better products, better services, and better platforms, and more profits in the future. So thank you to all of you again. I'm very grateful, very tired, and looking forward to a wonderful Christmas.
Thank you very much, Charles. Thank you very much, Giulietta. Those questions not answered, we'll cover in the interviews the rest of the day. But also, if you've posted it in Q&A, you can hang fire for a few minutes after this. There are a couple of us that will be answering those questions in the next few minutes for you as well. But thank you very much, Giulietta. Thank you very much, Charles. And a special thank you to everyone that joined us today. Have a good rest of the afternoon.